The problem the problem of this uh, huge premium of cash markets over paper markets is it's pulling the pants down, if you will, of the Western markets. They're not real. And my past business partner, Jim Sinclair, talked about he envisioned the day where COMEX gold would be $10 an ounce offered, no one willing to buy, and China $50 an ounce bid and no one willing to sell. I mean, the rule of law has been chipped away at for years and years. The biggest thing in the legal system, and we would be remiss if we didn't talk about it, is the great taking. Those laws are on the books across the world. They started in 2014. The ink is dry. Um, all throughout the Western world, if you have stocks or bonds with a broker, they're for your benefit, but they're not your stocks or bonds. They're on the broker's balance sheet. Same thing with banks. If you put money into a bank, you're no longer a depositor. You are a lender, and you're the most subordinated lender. So these laws have been put on the books to basically, when things collapse, everything's going to be taken. The best way to protect your assets is to have as few or no intermediaries between you and your capital. Meaning, if you want to own stocks, hold the certificates. The certificates are like a deed of trust or a title to a car. If you want to own gold and silver, don't do it through an ETF because A, they don't necessarily even own gold or silver. They own contracts, and it's on your broker's balance sheet. It's not yours. So you're better off if you're going to do gold and silver, own it outright yourself, either in hand or at a private non-bank vault. Yeah, what you do is, and not all stocks, there are some companies that don't even participate in it. You can't get ETFs and you can't get mutual fund certificates. But generally speaking, for most stocks, you still can get them. You call your broker, you tell them that you want to send your shares to the transfer agent under DRS, that's direct registration of securities. Once the transfer agent has those securities, then you contact the transfer agent. You say, send me a certificate. And it generally will take you anywhere from, I don't know, call it 3 weeks, maybe 4 weeks. If your broker sends you the certificate, they're going to charge you $500. If you do it this way through the transfer agent, it should cost you maybe $50 per certificate. But think of that as an insurance policy that if your broker goes under, it doesn't matter because you have title in your hand.
In an environment where intermediaries carry growing risk, asset protection increasingly comes down to direct ownership. Holding stock certificates through direct registration removes reliance on brokers. Physical gold and silver held personally or stored in private non-bank vaults eliminate counterparty exposure entirely. Exchange-traded products and pooled vehicles may track prices, but they depend on layers of promises. Direct ownership is slower, less convenient, and sometimes costs more upfront, yet it restores something rare in modern finance: clear title. In times of stress, certainty often proves more valuable than liquidity.
I'm really not sure. I'm sure that, I mean, there's no way you're going to get a certificate with crypto.
But you can put it in your own
wallet.
This
is really not a topic. Right. Yeah, you can do that. You can put it in your own physical wallet. But this is really not a great topic for me to talk about because I don't believe in crypto at all. I believe it's digital air. Yeah. I think people are going to find out that it was just like GLD, SLV, the other ETFs. I believe that crypto was created as a pressure relief valve from the demand that was going to go into gold and silver. And go one step further. I mean, crypto has been advertised, lauded, et cetera, by mainstream media, CNBC. I mean, they do so much and have done so much on crypto. And I believe the powers that be wanted to see crypto, take off and go to the moon. because that would attract capital that otherwise, wanting to get out of the system, would have gone to gold or silver. Right. And at least they're not sending out counterfeit coin or bars.
Well, that's
But
even
yeah,
worse.
it's
That
very
would be
unfortunate.
that would be worse.
Yeah, no, it's unfortunate that this is happening. I mean, but you see it in every in every facet of life, people trying to steal from you every day. I would just say that if you're going to look to buy gold and silver, look online and see where prices are. There's probably 8 or 10 major dealers that you'll just type in gold or silver. You look at Google it, they'll come up, and just look at their prices. And if somebody's way out of whack, or if they're telling you, oh, you have to do this special coin, you know you're being scammed.
Silver's fundamentals tell a story most price charts hide. For years, global silver demand has exceeded annual mine supply by hundreds of millions of ounces. Industrial use, once secondary, has become dominant. Solar panels, electrification, medical technology, and advanced computing all rely on silver's unmatched conductivity. New developments in electric vehicles and artificial intelligence have only intensified demand. Meanwhile, supply growth remains constrained because most silver is mined as a byproduct of other metals. Low prices discouraged investment, and now production cannot quickly respond.
Well, and we'll get to this in a minute, there's a bifurcation between paper metal and physical metal exchanges. Just as a background, silver has been in a structural deficit for at least the last 5 years. And when I say structural deficit, for instance, this year, you're looking at demand somewhere around 1.3 billion ounces versus 850 million ounces being produced collectively worldwide for a year.
Yeah, so, supply demand is way out of whack. Yeah.
Right. It's been out of whack for 5 years, and we've argued that there's something really wrong. Well, what's happening now is, this year, the last 2 or 3 years, there's been huge demand that was not, I shouldn't say not anticipated, but not calculated in. And that huge demand is for, the green industry, solar panels, etc. Now the big thing in 2025 was AI. Well, AI cannot be created without silver. I think it was Samsung said that they've invented a new EV battery that charges in 9 minutes and goes 900 kilometers, but it uses a kilogram of silver for each battery. That's 32 ounces per battery. I mean, that's just going to be huge demand. The AI model does not work unless there's more silver. And the problem is they've suppressed the price for so many years that the mining industry, most silver that comes to market is a byproduct of lead, zinc, nickel, et cetera, et cetera. There's very few pure silver mines in the world. So the supply has not even come close to keeping up with demand. And now we've got bigger problems coming up with supply. You've got, we know that Chinese companies, Indian companies, et cetera, are scouring Latin America and try to buy doré directly from the miners.
That's right.
Before it gets to LBMA, before it gets to COMEX.
So that's
a problem.
Does that create a price distortion as well?
The global silver market is no longer unified. Western exchanges like COMEX and LBMA operate largely on futures and paper contracts, while Eastern markets increasingly function on a physical cash and carry basis. This divide has produced something unusual: physical silver trading at a premium to futures prices. In theory, arbitrage should erase that gap. In reality, it persists, suggesting delivery risk or outright scarcity. When buyers demand metal now, not promises later, paper pricing begins to lose credibility.
Well, it creates a supply distortion because now the refiners, those are going not to the traditional refiners. I mean, a Chinese company is going to ship it to their own refiner in China, and now the question is, does that even come back out of China? uh, they've said that after January 1st, or after today, they're not going to exporting any more silver. Well, what does that do to a market that's already upside down with supply and demand? Now, talking about the bifurcation, uh, COMEX and LBMA are primarily futures markets. They're paper markets. The deliveries out of, and they do deliver, you can get real metal, and those have picked up dramatically over really the last couple of years versus Shanghai, for example, which is a cash and carry market. It is not it's not a futures market. And a lot of people have talked about backwardation, where the spot market is higher than a future month. And without going into the reasons that should never be, well, the reason it should never be is because there's a time value to money. So the spot market should always be below the futures market. And it's not. The spot market is above the futures market because traders are saying, I want my metal. I want it now. I'm not waiting 30 days, 60 days, or 90 days. I'm not even sure if I'm going to get it. And there's been created a huge arbitrage spread of $7 or $8, and it's actually more than that now between the East and the West. The cash markets are trading much, much higher than the paper markets. That should be arbitraged out. It should have already been arbitraged out, but it's not because traders are either unwilling to take the risk of buying on the paper market, selling on the cash market, and then finding out they don't get delivered on the cash market. So they're ended up basically making short. They're short the metal and they have no way to get it. Or the other possibility is they're just not able to source it.
Wow. And so there's a source problem.
This spread between.
I'm sorry, keep going. Finish that.
Well, I was just going to say that the problem of this huge premium of cash markets over paper markets is it's pulling the pants down, if you will, of the Western markets. They're not real. And my past business partner, Jim Sinclair, talked about he envisioned the day where COMEX gold would be $10 an ounce offered, no one willing to buy, and China $50 an ounce bid and no one willing to sell.
Adding to the strain, large buyers, particularly in Asia, are sourcing silver directly from producing regions before it ever reaches Western vaults. Doré bars are shipped straight to domestic refiners, bypassing traditional hubs entirely. Export restrictions and strategic stockpiling further tighten availability. These shifts don't always move prices immediately, but they hollow out visible supply. When inventories are spoken for before reaching exchanges, the paper market may show abundance while the physical market quietly dries up beneath the surface.
Well, on Monday, there was 1.4, I think it was 1.4 billion ounces were sold on COMEX to push the price down the way they did. I mean, that's more than
right.
150% of total annual production. So it's laughable. And if anybody gives you a number, for either gold or silver that's where they're going to peak, they're full of crap because nobody can predict that. Nobody can forecast that. I'm going to tell you that silver now looks like it's going to become, if not the greatest short squeeze of all time, one of the greatest short squeezes of all time. I mean, go back to 2008, and I think it was 2015 or 16. You look at Volkswagen, there was $10 a share, and then the next day it's 300.
Well,
I mean, that's a short squeeze. And I think that's what we're headed for in silver. Yeah, and there's so many uses for silver. I mean, you just mentioned high tech. Look at the solar and the Green New Deal, medicinal values, technological values or uses rather. So there are so many different uses. You're absolutely correct. I don't believe that silver is going to trade at par 1-to-1 with gold, simply because gold, only 1 ounce of gold comes out for every 9 or 10 ounces of silver that are mined. And Gold is pure money, and we're living in a world that is bankrupting, and gold and silver are the only two monies on the planet that cannot bankrupt.
Silver's price history is volatile, and its future is impossible to cap with neat forecasts. What matters is structure, not predictions. A market with chronic deficits, expanding industrial demand, constrained supply, and heavy short exposure is inherently unstable. History shows that when such imbalances unwind, they do so suddenly. Silver may not replace gold as monetary anchor, but it remains indispensable, both as money and as material. In a world drowning in debt, assets that cannot default tend to reassert their relevance, often when least expected.